When does tail risk matter most? Have you ever wondered when tail risk truly becomes a game changer in the world of options trading? Tail risk is all about those rare but extreme events that can lead to significant losses. Understanding when this risk matters most can help you manage your investments better. Tail risk becomes especially important during times of extreme market stress. This is when asset prices can swing far beyond their usual range, often moving more than 3 standard deviations from the mean. Such events are often referred to as tail events. They can lead to sudden and severe losses that traditional risk models often overlook. For instance, during financial crises or geopolitical turmoil, markets can experience abrupt price swings. These shocks create large movements that fall into the tails of the return distribution curve. This is when tail risk really comes into play. Traders and investors need to be aware that typical diversification strategies may not protect against these extreme outcomes. Tail risk is particularly relevant when market volatility spikes dramatically. When prices move outside normal expectations, the potential for loss increases significantly. Another situation where tail risk matters is during systemic shocks or black swan events. These are unpredictable occurrences that disrupt normal market behavior. If your positions are highly leveraged or concentrated, you may be more vulnerable to these outsized moves. Options traders should also be cautious of sudden, large moves in the underlying asset. These can lead to significant gains or losses that go beyond typical scenarios. To manage tail risk effectively, traders often use hedging strategies. These strategies provide asymmetric protection. For example, buying out of the money put options can help limit downside exposure. Employing spreads designed to protect against large losses is another common approach. These strategies become even more crucial during times when the likelihood of tail events rises. This can happen before major economic announcements or during periods of geopolitical uncertainty. It is also essential to understand that financial returns do not always follow a normal distribution. Instead, they often exhibit what is known as fat tails. This means that extreme events occur more frequently than traditional models predict. Managing tail risk is an essential part of risk control for traders and investors. By recognizing when tail risk matters most, you can better safeguard your portfolio against rare but impactful losses.